We're going to cover kind of the basics, guys. You have to underwrite with the new assessed property tax rate. Okay, we can't underwrite the debt service coverage ratio with the seller's tax rate, which he bought the property 50 years ago, and he's paying $2,000 a year, and now when they get reassessed. That's what people are battling. I'm seeing it all the time lately on these kind of 5 to 25 units, is that they're not underwriting their numbers correctly. So they're frustrated when they're not getting the max loan they think they can get, and they have to come in with more cash, which means returns aren't as good.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Hello and welcome to another episode of the Investor Financing Podcast, and I'm your host, Bo Eckstein. And today we're going to talk about debt service coverage ratio for multifamily, especially with the smaller multifamily deals. We're going to cover kind of the basics, guys. You have to underwrite with the new assessed property tax rate. Okay, we can't underwrite the debt service coverage ratio with the seller's tax rate, which he bought the property 50 years ago, and he's paying $2,000 a year, and now when they get reassessed, right? We got to look at those things. We got to put in the correct insurance amount. We got to put in a vacancy factor. Okay, there's always going to be a vacancy factor, even if it's a small multifamily of 8 units and it's 100% occupied. They're going to underwrite this with at least a 5% vacancy factor, people. Make sure to put this in your underwriting, because at the end of the day, we get loan proceeds, max loan proceeds on a stabilized deal based on the debt service coverage ratio. It's got to be a 1.25 or greater typically on a stabilized loan. And that's going to determine what we can fund in max proceeds. So that's what we have to do. And so oftentimes I'm getting these smaller multifamily deals. I mean, they're pretty big loans, $2-3 million purchases. But when we underwrite the deal, and each bank has their own thresholds. I mean, right now, instead of COVID reserves, some banks are just underwriting with a 9% vacancy factor, which is going to basically give the borrowers lower loan proceeds. Not all of them are like that, but I'm just giving you an example.
You're listening to the Investor Financing Podcast. We'll be right back after this break.
And now a word from our sponsors. Want to save money on your taxes? Cost segregation is a strategic tax planning concept that saves money by deferring federal and state taxes through accelerated depreciation. Get a free benefit analysis today. Please visit costseghub.com for more information on cost segregation and all of our cost recovery services that can put more cash flow in your pocket.
Typically 5% vacancy factor. Got to factor that in. Even if you're self-managing, you have to factor in a management fee. All this stuff, you have to do it on your when you're sizing up the deal, because your max loan proceeds are your max loan proceeds. If you want to get the best deal possible, it's going to be, rates are great right now, but if you can't get loan proceeds that you're expecting, you're going to have to go into a bridge loan or not buy the property. So make sure when underwriting these deals, you're looking up what the new assessed value is going to be based on that tax rate in the city or county. Make sure you're underwriting with a management fee in there. Make sure if the lender requires a reserve account, you're underwriting for a reserve account per unit. All these things play into account. Or you could just call me and book a call below, and we can talk about the property you're looking to acquire or refinance. But at the end of the day, the cash flow is the cash flow from the underwriter's standpoint. They're not going to use 100% rent roll, even if it's there. Okay, so you gotta underwrite to the banker's standard to get the best loans right now. And Fannie Mae and Freddie Mac and Bank One over there and Credit Union over there, they all underwrite a little bit differently and have different guidelines. So we can help you navigate that. At the end of the day, max loan proceeds come out to be, what the debt service coverage ratio is. Now, if it's a big value add play, meaning you're going to raise rents, that's when you go into a bridge loan, because the goal would be to force the appreciation by raising rents. Maybe you're getting $600 a door and you could be getting $850. Well, that's going to dramatically increase the value of the property, and then you refinance it, stabilization. So that's what people are battling. I'm seeing it all the time lately on these kind of 5 to 25 units, is that they're not underwriting their numbers correctly. So they're frustrated when they're not getting the max loan they think they can get, and they have to come in with more cash, which means returns aren't as good. So anyways, debt service coverage ratio, put your numbers in correctly, and or call me and we can talk about it. But that's what I'm seeing on the streets, and I want to convey that to you. As always, appreciate you watching and listening. I try to bring you information that I'm seeing as I'm looking at deals and what's going on and what's working, what's not working, things to look for. Make sure you're underwriting your deals correctly. Thanks so much. Talk to you soon.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.